Welcome to Do I Need to Restructure My Company? This session is presented by BDO. Let's meet the panel. First, Jim Laughlin, National Practice Leader of Business Restructuring and Turnaround Services at BDO Consulting. Next, meet Bob Deal, member at Bodman. Please welcome Vlad Slapik, Senior Vice President and Special Assets Group Manager at Comerica Bank. Meet Michael Teplitsky, Partner at Winchurch Capital. And your moderator is Robert Berdenier, Managing Director of Business Restructuring Services at BDO Consulting. Robert, the floor is yours.
Good afternoon. Thank you for joining us. Today we have a really good panel. My name is Robert Berdenier. I'm a Managing Director with BDO's Restructuring Practice in Pittsburgh, Pennsylvania. Joining us today, and I'll let them introduce themselves, with Jim Laughlin, Mike Teplitsky, Vlad Slapik, and Bob Deal. Jim, why don't you introduce yourself, and then we'll go to Mike, Vlad, and Bob in that order.
Sure, Jim Laughlin, Managing Director with BDO Consulting. I'm the national leader of our business restructuring and turnaround practice. I've been involved in the turnaround advisory space for the last 35 years and have been literally involved in 250 different companies and or transactions.
Mike?
Thank you. Hi, my name is Michael Teplitsky. I'm a partner with Winchurch Capital. Winchurch is a private equity investment firm based in Chicago. We principally focus on the industrial economy, so invest a lot of manufacturing businesses. Winchurch today is investing out of its fifth fund, which is a $2.3 billion fund. And in total, we're currently managing approximately $4 billion. And Winchurch is differentiated in our interest in looking at both cleaner companies, underperforming businesses, and companies that are in big trouble. So bankruptcy, restructuring, and turnaround kind of deals.
Vlad?
Vlad Slapik, Comerica Bank, Senior Vice President, been there 21 years. I manage our Michigan, Midwest-based special assets group, primarily middle market and business banking. Obviously heavy focused in commercial and industrial, and just continuing to do the same throughout every little blip in the economy. So,
And finally, a deal panel wouldn't be complete without an attorney. So, Bob?
Thank you. Bob Deal. I'm a partner at Bodman, which is a business and banking law firm based in Detroit. I chair our banking and bankruptcy groups and work on a number of restructuring matters for our business and banking clients.
Thank you, gentlemen. And first off, thank you so much for joining the panel today. So in a lot of the deal makers conferences, you will find a presentation on deal preparation. And indeed, you'll hear a lot about that as you're in other sessions. But today we thought we would take a different approach to this. So oftentimes you may find a company that's in distress, or you may find a company that needs to refocus themselves because some unforeseen event happens. So I thought this panel would be interesting to take a different look. So Jim, I want to lead with you. So from the turnaround advisor's perspective, what are the most important topics that should be addressed as part of a due diligence, if you see yourself going into a distress situation?
Sure, Robert. First and foremost, I just would mention that distressed investing, certainly as Mike knows, has been a very, very interesting asset class, if you will. A lot of money has been made in the space over the last, several decades. Interesting to note that, it's generally a less crowded field, though getting, more and more crowded each cycle. It's not for the faint of heart. You're stepping into situations which are often burning platforms. So the investor needs to be prepared to step in and use all of the tools in the kit to be successful in turning around the business and making sure that they can generate the type of returns commensurate with the risks they're taking. First and foremost on my due diligence list would be to understand what happened. How did the company end up, on the list of distressed businesses, in bankruptcy, going through a restructuring, or finding themselves having to be involved in a forced sale transaction? I think that secondly, and most important, there needs to be a solid hypothesis in mind by the investor. Obviously, that's not unique to a distressed investment. A healthy company investment also requires an idea or a blueprint for the future. But in these situations where there's clearly some trouble, clearly some hair on the business, I think it's important that there be an understanding going in. Was this a cyclical issue? Or is there something longer term happening with this company or with this industry sector that could impact the ability of the business to turn itself around? The other point I would make would be, are there enough competitive advantages in this company to make this investment opportunity worthwhile? There's going to need to be, as part of the investment hypothesis, a turnaround strategy, a turnaround plan to rev that business model back up to where it can grow again, generate the type of profits that are necessary to create value for the new investor.
So thinking about that, Mike, so Jim talks about a hypothesis. Jim talks about where the business is going, what got them there, how are we going to get out? So, as you mentioned in your introduction, Winchurch is always interested in looking at deals. Some, as we say, are a little hairier, some that aren't. Talk to me about what you're looking at from the investor's point of view.
Sure, I'd be happy to do that. Look, so Winchurch sees over 1,000 deals or ideas per year, so there's a lot of flow. A smaller fraction of those are classic distress restructuring kind of deals. And what actually ends up happening, this is what makes sense, is our flow in the restructuring and distress is highly correlated to U.S. Chapter 11 filings. So those are obviously very cyclical and really tied to the economic activity in the United States. So the last big wave of Chapter 11 filings obviously was in the last 12 to 18 months. But the one prior to that was the Great Recession, which was a decade ago. So, and then between that, we had 11 years of a bull market. So when Winchurch is looking at these complicated deals, essentially we have good lessons learned from the last recession that most of our team was at Winchurch and even before that. So really the DNA is around identifying businesses that have a reason to exist, sort of the Porter's 5 forces that you talked about. And ultimately, we have lessons learned in different industries. So Winchurch for the last decade has done really well in building products. The decade prior to that, we had meaningful success in automotive, although we did have some complexities on a few deals, but overall it was very successful. So ultimately, we're looking for industries that we know, companies that have a reason to exist. And then furthermore, as we evolve in diligence, we're looking at, okay, how do you capitalize this business? Does it survive if it continues being in distress and the turnaround plan takes a little bit longer? Where is the macro economy overall headed? And then ultimately, what does the turnaround plan look like? Is it an operational fix? Is it a commercial fix? Is it a strategic fix? Or are things going pretty well from a perspective of business positioning, and it's just a macro issue? You just need to wait for the cycle to come back. And ultimately, lastly, but maybe the most important question that you always think about first is management. So who's going to engineer the turnaround? Who's on the bus today? Are those people in the right seats? Do we need to bring in people from the outside? And what's ended up happening in the past is overall, in all of our deals, we've had to bring in new CEOs about 60% of the time. But when you look at the most complicated deals, the distress and turnaround deals, it's probably it's over 90% of the time.
Yeah, thank you, Mike. So Vlad, when the world hears special assets, or some people call it workout, the the CEO, CFO starts to quiver a little bit. Tell me first off, from your perspective at Comerica, does workout or special assets mean that you're getting ready to fire the client? Or how do you approach that, number one? And then number two, levering off of what Jim and Mike have just said, how do you approach the thesis that we got to understand what happened and where are we going and where are we heading?
Yep, thanks. I believe the workout or special assets has kind of evolved over the last few decades. When I first started 20 years ago, the approach was a little bit different as it is today. And that's kind of a mix of who's in the business, the type of businesses we now bank. And also, for example, again, with distress situations, solutions or exit process. So, the market is different now. So, there's no real one playbook of how we approach these any longer. And I think that's something important for, borrowers, debtors to know that, the process is really what they want to make it. And a solution is quite frankly, more largely dependent upon their cooperation and their ability to execute than it is for us to be, maybe creative in structure. So, it's just a different process of how I think this industry and how we have evolved. Going to the second part of that question, which is what do we look at? I mean, to be repetitive, immediately, what's the issue? Right? Is it pricing? Is it operational? Is it management? We really can't do anything. And the key there is, right, we're not running the day-to-day. We're not on the ground. And so, somebody like Jim is key to refer in and help us understand whether it's just one bank or multiple banks. It's help us understand what the key issues are. Without a true understanding and a story as to why we're in this situation, it's very difficult for a bank or banks to understand how to be a partner in solving whether it's a short-term or a long-term solution. And beyond that, it's what is the resolution and what's the time frame? Is it a quick solution or is it a long-term solution? Typically, things that we don't like to hear is being patient, but patience is really one of those that all involved have to accept that if it's a solution in order to, whether it's a refinance, a sale, or a restructure, if it was easy, none of us would be on this call today and everything would be solved already. So, that's one where it's very difficult. And sometimes when you have to report back to people for approvals or things, patience is not something everybody loves to hear. But, understanding exactly where we're heading and what the time frame is and structure, around what the ideas and just again, making sure that there's execution milestones and things of that nature. So that's kind of where we look at when we're getting involved in distressed deals.
So thanks, Vlad. So Bob, you've now heard Jim, talk about where the company's been and what happened. Mike has expressed to us we need to understand the long term if he's going to come in. Vlad has suggested that patience is not a virtue in workout, but that there's always a sense. Can you sort of help us identify some of the critical diligence items that are most prevalent when you're looking at distress or when you're trying to help the client figure out, where do they need to go? What do they need to do?
Sure. Well, at the same time, special assets is getting involved. Restructuring counsel is going to get involved both on behalf of the lender and on behalf of the borrower. And from the lender perspective, there's important due diligence to be done at the start of a matter. And first and foremost, to make sure that the loan documentation and the collateral package align with the bank's internal approvals and expectation. And then secondly, to look outward and try to understand where risk may arise, legal risk may arise, whether that's from the borrower, from sub-debt, from customers, from litigation. Some of these things may be the precipitating factors that are causing the problem. They may not be purely legal. the legal may have caused the business problem. And I think that then as we're working with the business folks in trying to identify a exit strategy or restructuring strategy, to understand what timeline is required and whether some of these legal risks may interfere with the intended path.
So Mike, one of the things you said a minute ago really interested me, and oftentimes when you're looking at a deal, oftentimes you're evaluating not only the deal and the thesis of the deal, but who's sitting in the leadership seats. Can you expand on that a little bit more? Because oftentimes if you're the CFO in one of these deals, and somebody like Winchurch shows up, you feel like your professional lifeline is endangered. Could you walk through sort of that thought process? And then I want to follow up with Jim as to how a financial advisor could help along that path.
Sure, I can briefly talk about that. I think it's to adequately answer that question probably would be a multi-hour session, talk about management theory and crisis management. But look, in summary form, it's actually pretty straightforward. Most of the time, businesses that are in distress find themselves in distress driven by management decisions. I'd say majority of the time that's the case. Some of the times it was some other factor that was outside of management's control, and they did all the right things, and that still wasn't good enough. So really is a judgment call when you're looking at these deals. But I would say the following. Ultimately, once we dig in and try to do a rapid assessment on sort of what Jim talked about, what went wrong, and where does the situation look like today? Ultimately, it's about, okay, well, what does the liquidity look like? How much cash you're going to need? Who are the constituents? What does the restructuring timetable look like? What does the operations of the business look like? What's happening to employees and customers, et cetera? So many variables. But then you ask the question, the critical one, okay, well, who's going to be riding the ship and putting together a turnaround plan and executing it? Who's going to take ownership of it? And really, the CFO that you talked about, candidly, is sort of like the second question or the third or fourth question. It's really the CEO question is the primary one. And many times that individual is not in the driver's seat, so you have to go and grab them from somewhere. And then it's a question of, can you get a generalist? Is it a finance person? Is it an operations person? Is it sort of quote unquote a band-aid, somebody just not in any sort of a bad way, but just somebody good enough to get this thing to the other side, and then you've got more time to look for somebody maybe with industry experience that's the longer term solution. But it ultimately comes down to, again, the value creation plan and what's required. Is it a big operational turnaround and you need an expert in lean? Is it a customer issue and you need an expert in pricing strategies and somebody that really has intimacy in some sort of an industry? Like, is it a Boeing problem and you need to have somebody with experience with Boeing and the U.S. military? Questions like that.
And Jim, so now you think about how Mike thinks about this, and we'll come to Vlad here in a minute with a similar question. So we're often called in these distress situations. Either Mike or Vlad have said, we've got a problem. How can a financial advisor plug in to help solve those issues? Where do we start, and kind of what does that look like?
Well, I think, Vlad mentioned that there's a need to get the straight story and get to the bottom of what is really going on. And I think that oftentimes there's a pride of ownership, even if that or authorship, perhaps. Even if the business has gone south or sideways, there's a desire as a management team, which is just human nature, to defend the status quo. I didn't really do anything wrong. We're a victim of our circumstances, et cetera, et cetera. And really investors and banks and really employees and ownership and everyone just needs the straight scoop. What went wrong? What's going right? What's it going to take to right the ship? How much money is involved? And then really to get involved in providing all of the tools that are needed to answer those questions. I go into every situation. The first thing I do, whether it's working with a company or doing interim management, or for that matter, advising a lender group, and I want to perform a SWOT analysis. I want to understand the strengths and the weaknesses, the opportunities and the threats that any given business is facing. And I want to do that in a way that's both qualitative and quantitative, and not go around and around on anecdotal, often finger pointing exercises where finance doesn't like marketing, which doesn't like engineering. You get the picture. So to really dig in and identify where are the strengths, what are the weaknesses, and the whole objective is to exploit those strengths for value creation, while at the same time eliminating the weaknesses or at least reducing them, so you can compete effectively and profitably. When we start to get involved in looking at opportunity and looking at threats, it gets a little more macro in understanding the industry, the structure of the industry, where the company fits in. But it's an important part of the process to know whether or not this situation is one that's worth investing in, one that's salvageable, and one that we can drive future value creation.
Vlad, so now you've heard, kind of Mike and what Jim's thinking about as we step in. How important is it to you, as you've already sort of made the decision that this candidate, either you need to exit or maybe you're being brought in to complement what Mike's doing. How important is it for you to hear what Jim has come up with, number one, and number two, what Mike's objectives are? And then, when we're done with that, Bob, I'm going to come to you with, how do we think our way through that process from a legal perspective? So, Vlad?
Well, yep. A third party is key, right? It becomes an impartial opinion about, and a fact dive as well into, what's transpired. And again, going back to the story. And typically that story is provided without emotion. And so that's really key for banks. And again, it's coming with some short-term solutions, and then maybe potentially some medium and long-term solutions in order for an effective turnaround to occur. Or again, if it's a sale process or any other type of resolution. As it comes to support, whether it's a private equity deal or a individual entrepreneur, we definitely look at what their willingness to support, again, whether it's time and expertise, financial, but there's a real good balance as to what everybody can bring to the table and how that individual or that group can take these resources, consultants, attorneys, and use them to benefit, as opposed to looking at how to maybe move something from one pocket, to the other in order to gain time. So, I think that's really it. At the end of it, you really want a team approach, and we want to see, ownership really focus in on the professionals who are trained and do this on a daily basis to advise and then implement the best plan for banks in order to, again, going back to us providing, a shared solution.
So thanks, Vlad. So Bob, we've now kind of covered the macro issues here. Now we're going to move into some of the more tactical issues. And Jim, I'm going to follow on with you after this. So Bob, as counsel, and you're starting to advise clients, either current or future, what are some of the basic blocking and tackling steps if one of your clients or a future client starts seeing themselves talking to Vlad or one of his counterparts at one of the other institutions? And kind of how do you set them up for success through this process?
Well, I think that the key factors for success from the borrower side are integrity, competency, and transparency. And sometimes the borrower has run out of rope with the bank by the time special assets is engaged. And so that's where it's critical to have a outside consultant involved to try to reestablish that credibility and to make sure that there's transparent communication going forward. Typically, from the lender side, that engagement is going to become a contractual requirement of the forbearance agreement, and that's really the way it's going to proceed from there. And so, really, you have to accept that. The big picture question is, what is the exit strategy, and can the bank and the borrower agree on that exit strategy? If there's alignment, then the process is going to go a lot more smoothly and is much more likely to be successful.
Okay, and Jim, so Bob touches on reestablishing that credibility with the Win Churches and the Comerica's of the world. Kind of walk us through kind of how we would go about doing that. Specific steps, and maybe if you had a good example of one of the places where we've really been successful at that, because oftentimes, bankers will say they've gotten lender fatigue, and how do we rejuvenate that lender if at all possible?
Yeah, I think that we spend a lot of time building our own personal professional credential. There's experience working with us. Bob mentioned, integrity, transparency. Our job early days in the business assessment phase is to call them like we see them, to be unemotional, and to be numbers oriented, because we're dealing with numbers oriented people. They want to know what's going on. How bad is it? Oftentimes, the extent of the problem simply hasn't been fully explained or explored or quantified. So it's incredibly important that we be very specific and very straightforward. Some years ago, I worked on a situation which was quite interesting. Everybody probably is aware of a company. Everybody owns one of their products. They may not know the name, but Werner Ladder Corporation is the largest ladder manufacturer in the world. I went in some years ago to be the chief restructuring officer to try to help guide them through the restructuring process, which included a Chapter 11 and a lot of operational performance improvement initiatives. Why did I get elevated from CRO to CEO, which is an important thing to note in these situations? Because the CEO quit. Very, very often, they don't have the desire, the stomach, or the resume to really go into a Chapter 11, deal with irritated lenders, deal with loan-to-own guys, who are looking for an advantage, during the case. And that's very, very common, that there's an interim need for senior management, whether it be a CFO or some other role at the company. So in that case, I became the interim CEO. And the SWOT analysis and the assessment that we did determined very quickly, and it was pretty obvious, they're a ladder maker and they had lost the Home Depot account. Bob Nardelli came into the company. He was the CEO of Home Depot at the time, and made a decision that they were going to develop some low-cost Chinese manufactured private label products. So he came up with the Gorilla ladder line, which is still involved. You go to Home Depot, they're still there. So when you lose the largest seller of ladders, you have a problem, especially if you're leveraged. Series of dividend recaps, very successful company until this event occurred. So what did we do? We needed to do a couple things. We needed to implement a strategy to be cost competitive. So we decided to move the bulk of our manufacturing from Chicago, believe it or not, to Mexico. High labor intensive business. And the good news was it was actually a smarter play than going to China, because the shipping costs of ladders would ship a lot of air was not efficient. So once we got up and running, we had a low-cost manufacturer of leathers. We had a great brand. That was our strength. So we were able to get into Lowe's, the up-and-coming number 2, and become the branded ladder service provider at a competitive price where we could make money. Over the years, we went through bankruptcy. We came out. The loan-to-own guys had a great new investment, and we ultimately got Home Depot back. So we had both Lowe's and Home Depot now, and took a company that was doing about 25 million of negative EBITDA, turned it into 110 million positive, and 3 or 4 years ago, ownership flipped it to a European investor group at a tremendous profit. So again, going in and taking action. And just a comment, I know I've gone a little long here, but a little comment on management. Not everybody has the stomach to go in and do this type of heavy lifting. Industry guys are not always the right answer. I mean, what was the industry here? Was it a ladder company? Was it a manufacturing company? Was it somebody who understood supply chain? Sometimes it takes a multiple or multi-talented group of people with resources to make these things happen, especially if you're going through a process as intensive as a Chapter 11. So again, positive outcome, a company that had some really, really positive strengths to work with.
Okay, so Vlad, you've heard Jim talk about a specific example, and Bob indicated, again, it's credibility. You're the banker. You're the receiving end of lender fatigue, right? You're the guy issuing lender fatigue. How do we turn that ship around? You've got Mike out there trying to put new money in. You got Bob out there putting deal docs together. How do we fix lender fatigue from your point of view? And do you have any good examples of how that's been cured?
Well, communication, Bob's point about transparency and in real-time communication. And ultimately, what's the ask? Because I think that's typically sometimes what may drive some of lender fatigue is companies are looking for answers as opposed to providing answers or, and looking for solutions. And so we really want to know what the ask is and again, what we should expect the outcome to be. Is it just time? Is it time and money? If we're being asked to invest more, is it investing more of an ABL where it's just an asset-based type increase in exposure, or is this something that's enterprise value specific? Will something that banks provide yield a improved enterprise value, or is it preservation? So we need to understand those. And so to me, lender fatigue is typically more of a questioning management team and as opposed to somebody that's coming with answers. We understand, right? Not every plan is going to be perfect. Now we expect it, but we understand it won't. But without those and without that, real-time communication, and again, it's from not just Jim, it's from the company, it's from their counsel, it's from everybody involved, that really kind of reinvigorates that lender support. Because if you see the time and effort and the resources being placed into an improved situation, as Bob said earlier, if you do it all together and there's a solid process that usually results in a better outcome for all parties, and so that's really where we look at for improving that relationship.
So Mike, you've just heard Vlad talk about this, where they think about what's the story, what's the outcome, how have they planned through it. When you're looking at a new investment that might be a little distressed, are you aiming to try to keep the existing lender in place, or are you looking for new alternatives, or what's your preference there, and how would you go about evaluating the debt and or equity stack as you're working through a distressed deal?
Sure. I guess there are a couple of questions in there. The first one is around whether the lender wants to stay in. The second question, maybe if you could clarify a little bit.
I'm just thinking about, is it easier for you to try to keep the existing lender in place, or if possible, or do you want to try to replace that lender? And does that affect your strategy on how to deal with the potential deal?
Sure. Great question. So in my mind are spinning a bunch of bankruptcies where or restructuring where we pleaded with the lender to stay in, and they just wanted out. And I think a lot of times that happens. There is also, just like there is fatigue within the management ranks, there's also fatigue within the lender. And by the time it emerges into some sort of a distrust process, before that, there's probably quarters of like, hey, this is getting worse and worse and worse. Let's assess it, and then let's bring in guys like Jim to tell us what's going on. And by the time it gets to a Winchurch, a lot of times the bank is like, just get us out of this thing, and we just want to get a recovery. So, our preference, I would say, is the following. A lot of times it's actually better to have the old money, pre-money lenders stay in, because they know the credit. It may allow for you to have, as a new money coming in, some preferences with respect to a process. Maybe it doesn't need to be it's at the cost and the fees, etc. Maybe quicker. So sort of a planned deal. Having said that, I think a lot of times the incumbent lender, because for many reasons, they don't want to even entertain the notion of staying in. So then you're looking for new money, and also at the same time trying to figure out, okay, how do I value this thing, etc. And a lot of times new people coming in are going to be more scared of the transaction, so it kind of pushes pressure down on pricing. So whereas if the old money stayed in, it would have maybe given more conviction to the deal. But Winchurch, how do we come into these deals generally? For the distressed deals, a lot of times it's maybe saying, okay, how much can you put on the ABL and making the rest be just Winchurch equity? And then later on, once we fix the company, we pivot to some sort of normal structure, if you will. Sometimes we have to come in 100% equity, and we're just buying the debt from someone. And at other times, maybe it's a more traditional structure where there's a first lien, second lien, and then Winchurch equity. But I'd say, in summary form, I'd say that what the capitalization looks like at the time of the restructuring and what the recapitalization looks like 12, 14 months from there, once the business hopefully has been turned around, is obviously going to look hopefully very different.
Okay, thanks, Mike. So Bob, you've now heard, how Mike thinks about coming into a deal. You've heard about how Vlad needs to sort of get his legs back under him, how Jim and I would come in and work with trying to figure out the process. What steps are you going to take for counsel to help us achieve those? And then finally, what options are available to your client as we're working through, should Vlad decide to stay into the deal?
Well, normally what we do is we build milestones into the forbearance agreement to keep everybody on track. And those are not milestones that are unilaterally determined. They're intended to be objective milestones that everybody can agree on at the front end, so that if there's a blow in a milestone, there really is an issue, and it needs to be addressed. I think that's the best way of keeping things on track. Certainly, if a lender is fatigued in today's sort of robust market, there are people that are out there buying debt. And so a debt sale is another exit strategy for a lender. I don't think that in a middle market deal that happens as often as it's used as an exit strategy in syndicated deals. But certainly that's an opportunity for a investor to get a front row position in the restructuring by acquiring the senior debt.
Okay. Thank you, Bob. And so, guys, we're coming near the end of our panel. Does anybody have any final thoughts as we're thinking about this topic? I mean, restructuring is not something that you tend to hear a lot about. Any final thoughts, Jim?
I think that Mike hit upon it in his comments earlier. I mean, it's really important to have confidence in the management team that's driving the process. They need to be experienced. They need to have a game plan. They need to come up with a recommended strategy that they go to the bank and or others with. Too often, I think we do observe that management teams are a little bit of a deer in the headlight. They haven't been down this path before. So it's just a challenge for many sort of to get out of their own way in these troubled periods of times. So that's where folks like us can be helpful. And at the same time, I'm sure top of Mike's list is to go out and make sure he's got a bench of folk, short term and longer term, that he can turn to before he decides to put real money, into a situation. So the focus on the management team, what they're bringing to the table, and their sort of bias for action, if you will, to get the turnaround going in the right direction.
Thank you, Jim. So Bob, Jim, Mike, and Vlad, thank you so much for your time. We are now going to go to a live Q&A, and we hope you guys, everybody can join us there, and we'll be happy to answer any questions that came to mind out of this panel.